Welcome to this webinar titled The Business Lifecycle, brought to you by ASWATAX. Thank you very much for joining this morning. And we'll be going through tax planning for business owners. Tax planning, tax considerations. There's a lot to get through, to be honest. There's actually a lot to get through. When I was preparing the content and the slides, I quickly realized that this perhaps should have been over 2 sessions, but it's fine. We will get through everything. But it's more around, this webinar is more around, just raising the awareness and touching upon different topics, thinking about different ideas, and just painting a picture, basically. So yeah, as I say, thank you very much for joining, and let's get started. In terms of about ASWATAX, so ASWATAX is a chartered tax advisory firm, and we provide bespoke tax advice to business owners. So everything that you'll see in this presentation it's sort of the angles that we get involved with, along with assisting property landlords and high net worth individuals. So, for example, inheritance tax planning, international tax matters. But I would say the majority of our work is related to business owners. If you think about it, business owners, high net worths, property landlords are all connected in, these titles are all connected in one way or the other. So in terms of things that we'll be going through, we'll start, so it's the business life cycle. So we'll start from the very beginning, or pre-business, and then we'll move our way through the life cycle towards the end, which is inheritance tax planning. So structure on startup, limited company, sole trade partnership, staying compliant, remuneration strategies, personal investment companies, R&D capital allowances and other reliefs, EMI, CSOP and growth shares. These 2 particular chapters, you could say, I'll simply touch upon them, and that's about it. To be honest, all these areas, just if we were just to pick one of them, I can probably talk for over an hour just on one of them. So as I say, this is more around the awareness and the ideas. Trading premises, property business, insertion of a holding company, looking at demergers, EIS, SEIS, so attracting external investment, buying a business, exit planning, trade sale, inheritance tax planning. I've got my notes on this screen, so I might be looking left and right. But in terms of startup, structure on startup, so this is pre-startup in terms of how should we operate the business. So 2 main ways would be unincorporated and incorporated. Okay, unincorporated, we would mean a sole trader. 1890 partnership means a general partnership or an LLP, and incorporated would mean a limited company. Now, as I say, we're not going to go into detail, because then we can start talking about limited by guarantee or limited by shares, for example, or an unlimited company. So there are many other angles, but broadly speaking, you have 2 types, and what's mentioned on the screen: sole trader, 1890 partnership, LLP, and limited company. These are the 4 most popular, most common methodologies when it comes to trading. So for example, you also have employee ownership trusts, which we'll touch upon towards the ending. You can have a business run through an employee ownership trust, but those are not as common as these matters. So in terms of the factors to consider between unincorporated and incorporated, we said incorporated was the limited company, but from a legal perspective, we also have an LLP, as you can see here, an LLP, which is a limited liability partnership. Now, when we say limited liability protection, we basically mean, from a legal perspective, that the owners, those that run the business, are a separate legal entity to the limited company or the LLP. So we have a legal advantage when we're trading via a limited company. And this is something that needs to be weighed up in terms of what's the best way to proceed. Just keep in mind that when we said LLP here, yes, it's a separate legal entity, so you are protected from a legal perspective, but from a tax perspective, an LLP is treated as transparent, and therefore the partners are subject to tax personally. So we have that divide: personal, corporate. Sole traders, general partners, and limited liability partners are subject to personal taxation on the profits of the business in their personal capacity, so via self-assessment. But the limited company is a separate legal entity, as we mentioned, and therefore subject to corporation tax. In terms of privacy, so between incorporated and unincorporated, a limited company has less privacy. Why? Because accounts need to go to Companies House, CT 600 to HMRC, whereas a sole trader and a general partnership is just the accountants and yourself that would sort of know exactly what's happened behind the scenes. And therefore, the admin costs in running a company are generally higher. Why? Because again, accountants' fees for again the company accounts, the dealings with HMRC, the confirmation statement. There might be other things when it comes to specifically running a company. So generally speaking, broadly speaking, the costs to run a company are generally higher. Although if we come to number 6 here, there are other reasons for running your business through a company. For example, the R&D scheme, which we'll touch upon, is only available to corporate entities, and the super deduction allowance, which has now come to an end. The tax rates between unincorporated again versus incorporated, so a limited company here, will be subject to corporation tax at 19% or 25% due to the introduction of the new rules in terms of the percentages. And we might also have a hybrid rate between 19 and 25% versus income tax, which, as you know, is 20%, 40%, 45%. So one may say, blanket approach, just looking at tax rates, that is better to trade or to run the business through a company. Why? Because the corporation tax rates are lower. But that's where we come to point number 5, which is there is a 2-tier taxation for companies, meaning the company is subject to corporation tax on its profits. But then in order to access those funds in your personal capacity, you then have to pay income tax. So that might be salary taxation or dividend taxation. So that comparative calculation needs to be undertaken in terms of what exactly is happening, how much is required to live personally, as in how much money would be needed, how much money would need to be extracted from the company into your personal capacity. And number 7, when we say tax loss management, we mean that, for example, if you have a plan to set up a business, or if your client has a plan to set up a business, and it's sort of it's known, or it's obviously we can't say known, as in there's always uncertainty, but there's a good risk in terms of booking a loss for the first accounting period or for the first few accounting periods. So if we know that there's potential losses, then the advice there would be that you operate as unincorporated. So you operate either as a sole trader or, depending on the circumstances, within a partnership. Why? Because the losses can then be carried back 3 tax years, and can be offset against your income from the previous 3 tax years. So, for example, that could have been employment income or any income for that matter. If you incorporate a limited company and then you if you incorporate a limited company and you know that you are expecting losses for the first tax year or for the first few tax years or accounting periods, then the loss is stuck within the limited company. Why? Because we come back to the point around limited liability protection, or around the fact that for legal purposes, a limited company is a separate legal entity. So that's a few things that need to be kept in mind. In terms of key compliance areas, this is effectively the due diligence that it's effectively due diligence. So I'll just quickly go through them. We have the monthly responsibilities for business owners. There's the weekly, monthly responsibilities in terms of payroll and handling expense claims. We have the P11D reporting, so taxable and exempt benefits must be reported to HMRC no later than 6th of July following the end of the tax year. And salary sacrifice as well, which is, I feel is becoming a bit more popular. We have employment regulations, so IO 35 status determinations, VAT management, so business owners, if the threshold is changing very shortly, but £85,000 quarterly VAT returns to HMRC, or it might even be annual or monthly. VAT attention for imports and exports, and also looking at cars, fuel and property. Annual reporting, we mentioned, accounts to Companies House, CT 600 to HMRC. So we're basically talking about the compliance areas here. We're not talking about advisory in that sense. We're talking about compliance. Corporate taxation. So corporate tax is payable 9 months and 1 day following the end of the accounting period, but there may be an instance where quarterly payments are required. So again, that needs to be complied with. Construction industry scheme, that's not something that we really look at, but as we say, industry specific. So there might be something specific to the industry that needs to be considered. And then personal taxation, which is the self-assessment tax returns for the owner managers, for the shareholders, for the directors, submitted to HMRC no later than 31st July following the end of the tax year. So all these areas need to be considered or need to be complied with. And I would say there's two main reasons why it's in the interest of the business owner to pay attention to such matters from the start. Number one being that if there are any areas, and there's a lot we've just mentioned, so I appreciate that the day-to-day lifestyle, the operations, the running of the business, business owners, they'll be, they're constantly getting dragged in different directions, and sometimes things can be missed. But it's important that these areas are well looked after. Why? Because if HMRC, number one, if HMRC were to come knocking on the door and they found an error or an issue in any of these particular circumstances, then what they'd look to do is they'd quickly look to go back, 4 years, 6 years, 20 years. So you'd want to keep everything in good shape from the start. And number two is, I'm not too sure, but generally speaking, when you start a business, there's many different reasons why one may start a business. And one end goal, one of the end goals are always, you start the business, you run the business, and then you are looking to exit for a sale. And when it comes to potential buyers, these are the areas, or these are some of the areas that they'd be looking at quite closely. So they'll have their team of advisors and they'd be looking at such matters. So again, if everything is kept intact, if you are running a tight ship, then, hopefully there'd be no issues going forward on a potential sale of business. Do we have any questions at this moment in time? Feel free to unmute yourself and ask if you have any questions. Okay, that's fine, no problem. Okay, then we have the topic of remuneration. So as you can see on your screen, there are 10 different methods that have been mentioned. And the most common from these 10 would be the top two on the left. So salary versus dividends. Salary versus dividends. I think the main angle here would be around, as in what we would do, generally speaking, is we would understand what the requirements are for the business owners in the first place, because there may not be a need to over extract funds, for example. So that's always the first thing that needs to be looked at. But following from there, as we say, salary versus dividends, there are pros and cons to both. So with salary versus dividends, there should always be comparative calculations undertaken, and this should always be reviewed regularly, at least on an annual basis. Because I've seen certain scenarios where nothing's changed. I mean, it's just the same thing, but the lifestyle requirements have changed, for example. So it's more about discussion with between the business owners and the accountants. When we're looking at salary, for example, salaries are deductible for corporation tax purposes. So if we're looking at a limited company, we do get the deduction for corporation tax purposes, but dividends are not deductible. Why? Because dividends are paid out of profits. So that's one comparison there. And then the other comparison would be salary. The income tax rates for salary are at 20%, 40% and 45%, as well as incurring class 1 national insurance contributions, both primary and secondary, versus dividends. There are no NICs, right? And also the dividend tax rate is generally lower. So 8.75%, 33.75%, and 39.35%. As I say, it's impossible to just say to have a blanket approach and just tell everyone, okay, do this, because there are the calculations that need to be undertaken, and we need to understand exactly how much income needs to be extracted in the first place. Then when we're looking at other strategies, charging rent. So what we mean by this is that the owner manager, the business owner, owns a property in his or her personal capacity. And the business uses this property. So it can be anything, right? It might be a warehouse, for example. But what the business owner can do is charge rent to the company. The company then pays the rent back to the business owner and gets an allowable deduction for corporation tax purposes. And that's one extraction strategy, because now the company is paying you the, I don't know, £30,000 per annum in rent. Now, of course, one may be thinking, okay, but the rental income is still subject to income tax to be declared on the self-assessment tax return, but the benefit there is around no national insurance contributions. Okay, and same with charging interest. So again, you start the business, you lend the business £100,000, for example. You charge the business, let's say 5% or whatever you may charge. For charging rent and charging interest, it should be market rates. Okay, if it becomes excessive, then HMRC will have an issue. But charging interest, again, same thing, no NICs, and you're extracting funds from the company. It's an allowable deduction for the company as well. And for charging interest, we have the particular angle, which is the savings allowance on the self-assessment tax return. We also have benefits in kind. Now, this can go into a lot of different angles, but broadly speaking, company cars is something that's quite popular, especially electric vehicles. Pension contributions is, again, a very good strategy to extract funds. Why? Because, again, the company gets a deduction for corporation tax purposes, and then you're also building up your pot. Now, when it comes to pension contributions, there's different ways to contribute. There's the normal contributions to any of the normal providers, but then you also have something called a SIP and something called a SAS. We'll come to that very shortly. In terms of consultancy charges, you may have a particular expertise You may have a limited company, there's 3 shareholders, for example, and 3 shareholders, but and the trade is operating in a certain industry, and you might have expertise in a different area. Okay, you might have expertise in a different area, and for that piece of work that you do for the business, you then charge the company a consultancy fee. We also have expenses. When we say expenses, we basically mean that, you know, maintain good records and maximize your expense claim, you know, within reasonable amounts. Loans is related to benefits in kind, meaning that you can extract £10,000 from the company completely tax-free without any personal tax issues. So 10K as a benefit in kind. But for that, you just need to keep in mind the Section 455 issues. And capital proceeds, we mean on the exit from a business, accessing capital treatment instead of income tax treatment. This is just a video that's on YouTube in terms of a video that I made, 6 profit extraction strategies, and then I talk about other areas as well, such as a holding company group structure, employee ownership trust, and some other aspects as well. Okay, so we spoke about extracting funds. We spoke about extracting funds. There's something else known as a personal or linked investment company. Now, it's not always necessary that funds need to be extracted in a shareholder or business owner's personal capacity. It's not always necessary, right? As in, you might need, or the business owner might need £50,000 per annum in his or her personal capacity, but then there's something known as a linked investment company, whereby it's a separate company that sits on top of the trading company or the trading group. This is something that we look at, particularly in the circumstances whereby a trading business has started to operate profitably, and there are excess reserves or excess cash sat on the balance sheet. And the business owners, they now want to utilize these funds for wider activities. Okay, so it's not for the trade. They want to, if it's for the trade, the advice would be different. But a personal or linked investment company or personal linked investment company, it's got many names, is a separate company which sits on top of the trading group. Now, the benefits of such a company is what you can see in front of you. Number one is flexibility. So you now have the business owners now have the flexibility in terms of extracting personally or extracting into this linked investment company. I'll just go back a second. In terms of what's the usage of a linked investment company, it's usually where, as we say, the excess cash is sat on the balance sheet and the business owners want to use the funds to invest elsewhere. Okay, so usually we see property, but we've also seen, you know, other things as well, such as crypto, stocks and shares. And we know that withdrawing funds, so let's just say the business owner wants to buy a property for £300,000. Now, we all know that to extract £300,000, we're looking at these kind of things, mainly salary and dividends. Even if we're just looking at dividends, then you can't extract £300,000. Technically, you need to end up extracting about £450,000. Why? Because then you have to pay the tax, and then you have the £300,000 cash proceeds or cash amount to then purchase the property. So what you can do here is dividends are tax-free between companies. So the dividend can go up to the linked investment company completely tax-free. So effectively £300,000 can go from the trading business into the linked investment company, and without paying any tax. So it's very, very beneficial. And yeah, effectively it's used for other investments. So when we say flexibility, we have that flexibility, right? We're not extracting in our personal capacity, rather we're extracting into a limited company. And per annum, every 6 months, whenever there's an event whereby funds need to be extracted, or any event for that matter, the business owner might have found a particular property and they want to move on it quickly, we have the flexibility. The other benefit is that you can introduce family members into this linked investment company. So the business owner may not want his or her spouse to have any sort of relation. It doesn't have to be spouse, it can be any family members, parents, siblings, children, but the business owner does not want that family member to have an interest in the trading business, okay? For natural reasons, right? You might have, as I mentioned earlier, the example, a trading business with 3 shareholders unconnected. But the benefit here is that you're still using funds from the trading business into the linked investment company, and you can introduce family members into that particular investment company. So what we usually see is business owners bringing their spouse into the shareholding, and children as well. How do we reduce tax and commercial risk? Well, we're talking about investments, right? So if you're looking to invest somewhere, let's just say property again, that's the most common thing we see, and you invest, you don't want to pay the dividend tax, fair enough, okay? The property we said is £300,000. You don't want to pay £150,000 in dividend tax. So you say, okay, I'll just purchase the property within the same company. Now that's no good. Why? Because you are diluting the trading status of the trading company or the trading group, which is negative for 3 reasons. Number one is that once you lose trading status, you also lose valuable tax reliefs. Number one being business asset disposal relief for capital gains tax purposes. Number 2, business property relief for inheritance tax purposes. And number 3 is something known as the substantial shareholding exemption for corporation tax purposes, which allows the sale of a trading company to be tax-free. Sorry, I know I'm a bit technical here, but it seems like most of you are. I did look into the registrants, and I think most of you do have a financial background. But feel free to ask any questions or put in the chat box if there's something that's not making sense. So reducing tax risk, and then commercial risk. Of course, you have the property now sat within the trade, and that trade may be subject to litigation. There might be some issues with customers and the rest of it. And I've seen this scenario as well, whereby a woman that we are advising in terms of agricultural property relief for inheritance tax purposes, she was just telling me the story. So we didn't see it real time, but she was telling me the story just a few years ago. She had a trading business, and she obtained no advice, or she might have obtained the wrong advice. And she purchased 2 residential properties within this trading company. The trading business had some sort of litigation issues, and she lost those 2 residential properties. So that's what we mean by reducing tax and commercial risk. That's why this linked investment company sat on top outside of the trading group is beneficial. Separating activities. So we're separating trading activities with investment activities. Dividend tax management. Now, what we mean here is by use of alphabet shares, A, B, C, D, E, or we can offset different levels of dividends. So the individual shareholder may get, £10,000, but the linked investment company gets £200,000, for example. And exit planning as well. The linked investment company, it is possible. So number one is, if you can just picture something. So I was going to prepare a slide to have the diagram, but I do intend to have a full 1-hour webinar on this particular area, linked investment company. Why? Because it's very beneficial and there's a lot more we can discuss. But broadly speaking, when we say exit planning, we mean that when it's time for the owners, for the business owners to exit the business, having the linked investment company sat on top, it allows the flexibility again in terms of how much of those proceeds, so you exit in the business, so you're selling for, let's say, £500,000 or £1 million. Now, you have the flexibility of those £1 million. Where is it going? Is it coming into your personal capacity, or is it going to this linked investment company for further investment? And these are all very positive benefits that business owners enjoy. We then come to the stage of the life cycle whereby, business has started and things are going on. We have something known as research and development tax reliefs or tax credits. As I say, a lot of these areas I can talk about for a lot longer, and this webinar is more around taking you through the business life cycle and explaining to you the different things that are available. So one thing that is available, which is very, very beneficial, is the research and development tax credits, which were introduced back in 2000. Recently, over the last few years, they have been, the word is, they have been exploited, you could say, okay? But it's still a very, very good method in terms of reducing corporation tax. So this is by far the best method for one to reduce corporation tax. But of course, there has to be research and development activities. So what we usually do there is to assess the situation first. But if there are activities that qualify for the tax credits, then effectively we reduce the taxable profits, therefore reducing corporation tax payable. And if it's a loss-making company, then HMRC payback 14.5% as a cash credit. So just last week, we helped a client obtain a cash credit. Why? Because it was a loss-making company. It was the first year, but they were doing research and development activities. And these are all areas that must be assessed in the first place, but it's something always to keep in mind, something to consider. Also, capital allowances. Now, the accountants usually would deal with the capital allowances, but capital allowances are an area whereby you can go into a lot of detail, and sometimes things can be missed. So the advice there would be maximizing your capital allowances claim. And then there are other reliefs available. So I've put two here: patent box and film tax relief. In terms of incentivizing staff, incentivizing employees or key members, we are looking at things like the enterprise management incentive scheme, the company share option plans, and growth shares. There are other ways as well. There are other schemes available, but EMIs are the most popular. In terms of the EMI scheme, effectively, as we say, it's about attracting talent, incentivizing and motivating staff. So the EMI share scheme is tax advantageous, whereby you can offer shares to the key member of staff tax efficiently. Same goes with the company share option plan, although there are limitations in terms of the value or how much shares can be offered. And then there's something known as growth shares as well. So if the schemes are not suitable, or if the conditions are not met, why? Because there are conditions that need to be met for these schemes, then there are other methods such as the unapproved share option plans and growth shares. Now, with all these share schemes, we must undertake valuations, because effectively you're giving shares away of the trading company, and therefore valuations must be undertaken. We move on to the trading premises. Now, we have a business, and the business is operating from rented property, let's say. Cash reserves have built up, and the business owners now want to purchase a warehouse. We'll use the example of a warehouse for, let's say, £500,000. Okay, in terms of this particular trading premises, there's a lot that needs to be considered. It shouldn't just be, just buy the property and that's the end of the matter. There is a methodology, there is a thought process. So number one would be, who should own the property? Should it be the trading company itself? Should it be a subsidiary company, or should it be a holding company? Should it be a trust, for example? Should it be the pension fund? All these questions need to be asked. Or, as we mentioned earlier, should the premises be purchased by the business owners personally and then charge a rent? So all these things need to be thought of and need to be considered. And then the second thing would be, how is the trading premises, how is the acquisition funded? And thirdly, I wanted to mention something called a SEIS, which is a small self-administered scheme. A lot of the times we see commercial property being purchased through a SEIS. So when I said warehouse, commercial property, right? And the benefit of a SEIS is that number one is we get immediate corporation tax relief, whereby contributions are made into the SEIS, but then, so effectively you're saving corporation tax at 19% immediately. But then the SEIS sits alongside the trading entity. Why should the SEIS purchase the trading premises? Because what then happens is the SEIS charges rent to the trading company. The trading company gets an allowable deduction, as we mentioned, for renting the property from the SEIS. So again, you're saving corporation tax for the second time. But within a SEIS benefits from a lot of tax advantages, and one of them being that there is no income tax, no corporation tax in a SEIS. So effectively, let's just say you're charging £30,000 rent again. You're getting the deduction on one side, and this is not common in taxation. And this is why I'm mentioning this particular angle. Usually in taxes, there's a benefit here, but then there's a drawback here. But here you're getting the deduction for corporation tax purposes, but the SEIS is not paying any tax at all. Also, the other benefit of having the property within the SEIS is that it is immediately outside the estate for inheritance tax purposes. And then again, you're preserving the trading status of the trading company, although if it's trading premises is not really an issue. Yeah, in terms of SEIS, again, as I say, it's an area that we can talk about quite a bit. But another reason why business owners like to introduce a SEIS into their affairs is the fact that you have full control and flexibility. So the pension contributions are not going elsewhere. It's effectively coming back to the pension trust or the pension fund, which is owned by yourselves or family members. In terms of property businesses, you have two types. One would be a trading property business, or the other is an investment. Now, usually we see investment property businesses, but trades would be, for example, property development. In fact, yeah, I've seen a few of those as well, to be honest. Property development, so buying and selling, buying a property, doing it up and selling the property, and some daily property-based services like hotels and car parks. So effectively, the key point of this slide, when we say investment, we say where property is generally held for the longer term and for the income it can generate, usually by letting. So I think that's understood. One of the main reasons we mention the property business and the trade and investment is the fact that the trading company, again, benefits from certain advantages, such as, again, BADR for capital gains tax purposes, business property relief for inheritance tax purposes, and the substantial shareholding exemption. So it's important to have the divide, and overlap requires our input. What I mean by that is effectively we have the 80-20 rule, and that's something that needs to be considered, as in at what stage are we calling a trading company an investment company? And that's the 80-20 rule for capital gains tax purposes, and for business property relief for inheritance tax purposes is 50-50. I've put down there residential business can potentially mean incorporation. I don't want to go too much into that, but broadly speaking, if one owns a fair amount of residential properties, so although it'll fall into the investment category, which is where property is generally held for the longer term and for the income it can generate, usually by letting, if we have a business overall, then there's something known as incorporation relief that can be accessed. It's just a side point, but the main thing to take away here is that there's two types of property businesses. One is the trading and one is investment, and the two must always be well documented, as in we should know that, okay, this is a trade and this is an investment company. Do we have any questions at this stage? Serviced accommodation. Serviced accommodation can be argued as a trade, but again, I think it needs to be looked at on a case-by-case basis. It can potentially be argued as a trade. We have another question. A client, dental practice owner, is buying the property he trades from. So a client, a dental practice owner, is buying the property he trades from. Can he put the property into a SEIS? He's a sole trader. Any advantages? A sole trader, a SEIS is only available for, it's only relevant for limited companies. So the answer to that would be, because he's a sole trader, the SEIS cannot be considered, but what he can potentially consider is incorporating if it's beneficial in his particular circumstance, and then consider a SEIS. But yeah, any commercial property, if you have any clients with commercial property, or they want to purchase commercial property, a SEIS should be always considered. Okay, so then we move on to the insertion of a holding company. The reasons to insert a holding company can be many, and it must be looked at, again, on a business-to-business basis. But broadly speaking, one of the main reasons, as in, if you look on the right, 1 to 6, these are some of the reasons why a holding company would be inserted. A key reason is around asset protection. So we have the standalone trading company, and within this trading company, we have commercial properties, residential properties, cash. We might even have intellectual property, all valuable assets. Now, as we mentioned earlier, there's potential risk of litigation. So what we would do there is insert a holding company and transfer these valuable assets upwards, tax-free via dividends. So the cash would go upstairs by dividends, and the assets would go upstairs via a dividend in specie. Okay, so the number 1 and 5 are sort of connected, but broadly speaking, the bottom line is those transactions are tax-free. So we're protecting the assets by inserting a holding company on top, and now we have a group. We have the holding company, and then we have the trading subsidiary. Separating de-risking trades. So I had a client recently, agency business, but as in he started out as an agency, but then he's is to 2 shareholders, unconnected, only connected by virtue of shareholding. And as we say, you know, the day-to-day life of a business owner is not straightforward. There's always different things going on. But effectively, at the end of the year, they effectively had 2 trades, and they were thinking of starting a 3rd business. It connected, but separate as well, if you understand what I'm saying. So separating de-risking trades, a good way to still have the same ownership in terms of 50-50 between the 2 shareholders. I think this one was actually 80-20 between the 2 shareholders, is that we'll have a holding company on top, we'll insert a holding company, and then we'll have 3 separate subsidiaries. As we say, limited companies are separate legal entities, and that's where this whole asset protection, de-risking of trades come into play. Why? Because it's a separate legal entity. So litigation, we might have banks or customers, for example, after the trade of one of the businesses. But if you have another trade in another limited company, it doesn't matter if the holding company is on top. There's no issues there. Group loss relief, SCLT relief, these are connected again. What we mean by that is we may have a business owner. Let's just come back to basics, 100%, okay? 100%. So business owner owns 100% of company A, 100% of company B, 100% of company C. Company A and B are making profits every year, but company C has booked a, I don't know, £100,000 loss. But the problem is that £100,000 loss is stuck in that company, okay? And the other 2 companies are still paying corporation tax at 19-25%. So what we can again do is insert a holding company, and then the losses can be offset against each other, thereby reducing corporation tax. SDLT relief, we might have again, husband and wife owning a property investment company here, another property investment company there, you know, completely separate, but they want to move the properties around, or they want to streamline their service, or, you know, their structure. So then you can potentially insert a holding company and transfer properties between the group completely tax-free, no CGT, no stamp duty and tax. And number 6 is pre-sale planning, which is substantial shareholding exemption on sale. If you have the trading company and you're the shareholder, the business owner is the shareholder, on sale, we'll be looking at business asset disposal relief at 10% on the first million, and then 20% tax on the balance. But if we insert a holding company, then the disposal can potentially be tax-free. That's something that needs to be looked at, the SSE. In terms of this type of work, we usually obtain HMRC clearance, and we can get everything set up in 6 weeks. I think one thing to note here is like, there are accountancy firms and the rest of it out there, other advisory firms as well. They're offering this service, but we've noticed a lot of issues in terms of the legals, the legal documents and filings. So you know, everything has to be done properly. For example, SSE on sale, the whole reason for this insertion of a HoldCo might be to benefit from SSE, but then the legal documents are not in place, and therefore, you know, you'll have a lot of issues, because the conditions for SSE, for example, you have to have owned the trading subsidiary for at least 12 months. So it's very important to look at everything properly. This is a diagram in terms of the holding company structure. So we have husband and wife, let's say. They own 100% of company 1, and they own 100% of investment company. And then what we do here is streamline, in the sense that they only own the shares in one holding company, which then owns the shares in the 2 companies. And then the beauty of this holding company structure is that other entities can simply be inserted, you know, without any hassle. So we can always be inserting companies underneath. Something else to consider. So right now we're at the stage, when we're talking about insertion of a HoldCo, demergers, we're at the stage of reorganizing the business to stay in line with the current circumstance. Okay, so all this it's always ongoing. It's not just like when something comes up. It's more around, you know, okay, that's going to happen in the future, or this is the plans, and therefore this is what we need to do. 3 types of demergers. I'll explain what exactly a demerger is, but 3 types: a statutory demerger, a capital reduction demerger, a liquidation demerger. A demerger is effectively, you have a group. So let's just say you have this group. Demerger is basically taking out this investment company from the group. Okay, we're demerging. Now, the statutory demerger is only available for trading entities. And in fact, this, you could say, is another reason why the trading status must be maintained. Liquidation demerger is not popular. Why? Because you have to liquidate, and it's not good. People don't, business owners, they don't prefer that sort of reputation, and also liquidation fees. And then capital reduction demerger is very popular when we're looking at separating investment properties from trading companies. And this is what I'm saying. It's very important to get the structure right from the start, because then technically you won't need to do certain other things. So what a demerger allows you to do is preparing for a future sale. So for example, I can give you an example. We have a trading business, okay? And within this trading business, there are investment properties, okay? It might be the commercial warehouse, or it might be residential properties, whatever it may be. But the business owners are preparing for a future sale, right? So, as in, it's known that the buyers, they're not going to be interested in the residential properties for sure. And on the flip side, you're not interested in selling those residential properties anyway. And then there's a lot of the times, even the commercial properties need to be discussed. So that's what we mean by preparing for a future sale, which is we demerge the investment properties. Number two is slightly connected, separating trading and investment activities. So we might have a company and we're looking to obtain SSC, for example. I'm just throwing out examples. There can be so many different things that are going on. But within the company, there's an investment property, and therefore we need to demerge. Making the company more attractive to potential investors, locking in CGT and IHT reliefs only afforded to trading businesses. We discussed that. And number five, solving shareholder disputes. We've seen that a few times, whereby so sometimes it doesn't even have to be a dispute, to be honest. As in a recent case, it's not recent, last year, we had two business partners, one in his 50s, one in his late 30s, and they built up a property portfolio of about £8 million. And they started about 10 years ago, about 12 years ago. And they simply came to the stage whereby the owner, the shareholder in his 50s, he's got a different plan for life now, as in he's seeing life differently. And this is what I'm saying, it's all about real life. It's about, day to day, month by month, assessing the situation. He has other plans now. The younger shareholder wants to continue doing what he's doing. And therefore we had to look at a demerger. But also disputes as well. So for example, you might have three brothers, they own shares in a property investment company that was passed on from their father, for example. They now have disputes. What do? We need to demerge. Now the demerger process is very complex and is very I don't like to use the word risky, because we've looked at them so many times, but I'm just saying you have to take care when looking at demergers. So things have to be done properly. But these are some of the reasons why a demerger may be considered at some point in the business life cycle. Attracting outside investment, EIS, SEIS, the enterprise investment scheme, the small or the seed enterprise investment scheme. There's different rules for each scheme and the conditions are different as well. Broadly speaking, SEIS only up to £100,000, EIS is more than that. So effectively, the 30% and 50% is you can get tax relief on your investment. So effectively, if you make £100,000 investment under seed EIS, then you get £50,000 back on your self-assessment tax return. So, it's very, very advantageous. Same with the EIS scheme. You're effectively getting 30% or 50% back immediately on your investment. And I think this is unutilized and there's a lot of potential here as well. In terms of how we assist, there's advanced assurance from HMRC, and then there's also the whole, the conditions, the scheme going through the stages, and the compliance matters as well. Sorry. We move on to buying a business. Okay, so buying a business. Acquiring other businesses come with financial, commercial, and tax risk, which all need to be managed. When we're buying a business, we might have a trade and asset acquisition or a share acquisition. Just keep in mind that trade is safest, shares is simplest. Why is trade the safest? Because when you're purchasing the underlying assets or the trade of the business, that's all you're acquiring. So you're just acquiring the assets and the trade, and you're not associated with any of the history of the company. So you buy, how you buy the trade and assets is a different story, but you might buy it into a new limited company. So it's starting fresh. You're not taking on the dirty history. You're not taking on a dirty company, as they call it. However, although it's the safest, we just need to keep in mind that, for example, if we're taking on property, if we're purchasing property, the asset, then we are paying stamp duty, land tax, which is a key consideration. And then the other would be a share acquisition. And we say it's the simplest. Why? Because you're simply purchasing the shares of the limited company and everything that's associated with it. You're not paying any, even if you're purchasing assets, even if there are assets held within this company, because you're purchasing shares, you're only paying 0.5% on the share value. So, it's a lot cheaper. But when we're looking at due diligence, then you are purchasing a dirty company, and therefore care must be taken to ensure that you aren't going to get any unwelcome surprises from HMRC post-acquisition. Exit planning. These are the options available for a business owner when it comes to exit planning. There is another one, in fact, that I didn't mention, which is succession to the younger generation. The most common is a third-party sale, so shares versus trade and assets. So it's the opposite of this. Generally speaking, when buying a business, purchasers would want to acquire the trade and assets, but when selling the business, you'd want to sell your shares rather than trade and assets. Why? Because when you sell your trade and assets, the cash is paid by the purchaser into the limited company. And then what you need to do is then you need to extract those funds by way of dividends, perhaps, or capital proceeds. If you're selling your shares, you're looking at straight 10%, 20%, or we might even be looking at things like SSE again. Sorry. The other method would be a company purchase of own shares. So this is where there are enough reserves available on the balance sheet. There's cash available as well. And effectively what happens is, let's just say we have 25% for shareholders, 25% each. One shareholder wants to retire. The company can purchase the shares of this shareholder, because it might not be, as in the other three shareholders, they don't want to sell it to someone else. They don't want to, they don't want to sell it they don't need another fourth shareholder. They want to maintain control. So that's why the company would purchase the shares of the retiring shareholder. Or it might even be a case on death, for example. On death, the 25% shareholder, the shares go to his or her spouse. But again, that individual has no connection with the business. And therefore, a company purchase of own shares is quite beneficial. And also, you can access the 10% treatment. Sale to an employee ownership trust has become quite popular in the last 3 years, I would say. It was actually introduced in 2014, but it's just sort of kicked off now, which is the beauty of a sale to an employee ownership trust is two. Number one is the sale to the employee ownership trust is completely tax-free. okay, completely tax-free, so 0% CGT. So we're not talking about 10%, 20%, we're talking about 0%. And also the market value price, so the price that you will be paid is determined by the business owner, because effectively you're on both sides, right? So this is something to consider. Care must be taken, but we shouldn't just be, 0%, therefore we're selling to an employee ownership trust. There are other things, such as how it works and the rest of it. And that is a webinar that I'll be holding at some point as well. Management buyout. The management team might be in a position whereby they can continue the trade. And therefore a management buyout allows the transaction or the exit plan to be conducted in a tax efficient manner. Typical shareholder acquisition, what do we mean by that? We mean, just that you're simply selling your shares. So for example, we might have, let's say, husband and wife. Let's say husband and wife are 50% shareholders in a trading company, and they want to start to introduce the next generation. The sale of the shares, because it's a trading company, we can access something known as gift holdover relief, and therefore they can introduce the children quite easily, right? So that's what we mean by a typical shareholder acquisition, by way of gift relief by a typical sale. In terms of the example I mentioned, which is the gift relief, that's not always the most beneficial, because that's very short-sighted in terms of thinking, because you have to remember the kids are going to obtain the base cost of your shares. There are ways to structure the transaction in a way whereby the children have an uplift in base cost of shares. And acquisition by NewCo. There was a case we were looking at recently, but effectively, yeah, the acquisition by NewCo, there's many reasons for this, and it's connected to a management buyout as well in terms of the tax implications. Trade sale, most important commercial transaction of business life. From a company perspective, the due diligence must be undertaken. And from the shareholder or the business owner's perspective, there's a few things that need to be looked at, which is number one, the valuation, quantifying the tax. We need to let the business owner know exactly how much tax may or may not be payable, refining the proposal in terms of the deal structure, protecting from tax risks, again, that's related to due diligence, and mitigating inheritance tax, because now you own shares in a trading company, could be worth 5 million, let's say, covered by business property relief for inheritance tax purposes. Once you sell the trading company shares for £5 million, you now have cash, which is not covered by business property relief for inheritance tax, and therefore there are ways to mitigate inheritance tax from the offset. And this is why advice is necessary. It's important to seek professional tax advice. Inheritance tax planning, what we just mentioned, trading and business property relief. So we want to maintain trading status, and therefore be covered by business property relief. To be fair, the Labour Party, they have been talking about capping business property relief to £500,000, which it will be quite detrimental to many business owners. Redeemable preference shares, again, redeemable preference shares will trust niche areas, but again, they should be considered on the sale of a business. Growth and freeze shares for investment companies. It's possible to freeze shares in an investment company, and therefore the value. So let's just say we have a property investment company worth 15 million, for example. Now, broadly speaking, property values increase over time, and debts, mortgage amounts outstanding reduce. So effectively over time, the value within your estate, the business owner's estate for inheritance tax purposes, is increasing. So there's a way to, as in one thing to consider would be the insertion of freezer shares within the investment company, and therefore the value within the estate for IHT purposes is frozen. I hope that was insightful. Apologies, I feel like I rushed a little bit, but at the same time, I didn't want to go into too much detail. As I say, I can talk all day, and as you've probably witnessed, my throat is already is gone. But yeah, these are basically things. It's more around the awareness. This webinar was more around the awareness that these are things that should be looked at different stages of the life cycle. How can ASWATAX help you? These are all areas that we have dealt with before and we continue to deal with. So if there's anything that needs to be looked at, then feel free to reach out. Do we have any further questions? Dissolved companies, do you need to do tax return for any trading profit? Trading companies stop trading. Dissolved company. If it's dissolved, then the company doesn't exist anymore. So if it's already been dissolved, then the company doesn't exist anymore. So yeah, if it's a dissolved company. As in prior to that, if there was profits, then yes, prior to that. But if it's already been dissolved, then that's a different story. Any further questions? I hope you found it beneficial. I hope you found it useful and very useful. Thank you. Thanks, Tim. Thanks for your comments. Yeah, in terms of the business life cycle, you know, there's so much we can talk about. As I say, we just touched the surface on a lot of these matters. But the main thing is to assess the situation real time. This is very important. And you know, and then there's a lot of, you know, credits available, reliefs available, structures available that can be introduced to assist from a tax perspective, but also from a legal and commercial perspective as well. So thank you very much for your time. And if you have any questions, these are my details. If there's anything to discuss, then please let me know. And I hope you have a good day. Speak to you soon. Take care. Bye.